Imagine this. One morning you open the news and RBI changes one number, and suddenly your EMI becomes 800 rupees cheaper every month. At the same time, your father's fixed deposit earns less interest. How can one number do this? That number is called the RBI Repo rate. In this video, I will explain it in very simple words. How this one number affects your home loan, your fixed deposit, and even the stock market. Let's forget complicated definitions. Think of RBI as India's money supplier. Banks are like shopkeepers, and we, people like you and me, are the customers. When banks need money, they go to RBI and borrow it. The interest RBI charges banks is called the repo rate. So repo rate is simply the price at which banks get money from RBI. If RBI makes this price cheaper, banks get money cheaper. If RBI makes this price expensive, banks get money expensive. And banks pass this change to us through loan interest rates, FD interest rates. Let's take a real-life example. Rahul buys a flat in Pune. He takes a 50 lakh rupee home loan for 20 years at 9% interest. His EMI is around 45,000 rupees per month. Now RBI cuts the repo rate. The bank reduces Rahul's interest rate to 8.75%. Now his EMI becomes about 44,300 rupees. That's a saving of 700 rupees every month. That's 8,400 rupees every year. Over 20 years, Rahul saves nearly 2 lakh rupees just because RBI changed one number. This is why every home loan borrower closely watches RBI meetings. Now let's look at the other side. Meena Auntie has 10 lakh rupees in a fixed deposit. She earns 7.5% interest, so she gets 75,000 rupees per year. After RBI cuts repo rate, banks lower FD rates to 7%. Now Meena Auntie earns 70,000 rupees instead of 75,000 rupees. That's 5,000 rupees less income without doing anything wrong. So borrowers smile. FD investors worry. This is why repo rate cuts are good for loans but not great for savings. Now let's look at a shop owner. Amit owns a small electronics store. He wants a 20 lakh rupee loan to open another branch. At high interest rates, the EMI is too expensive, so he delays expansion. But when RBI cuts repo rate, bank reduces loan interest. Now EMI is affordable, so Amit opens a new store, hires more staff, sells more products. This is how lower interest rates grow the economy. When RBI cuts repo rate, fixed deposits give less return. So people think, why keep money in FD at 7% when mutual funds can give 10 to 12%? So money moves from FDs to stocks and mutual funds. This is why when interest rates fall, stock markets often go up, because more money flows into investments. Now imagine the opposite. If RBI increases repo rate, EMIs become higher, new loans become costly, FD interest becomes higher, so FD investors are happy. Borrowers are unhappy. RBI does this when inflation is rising too fast and people are spending too much. Let's simplify it. When repo rate goes down, home buyers win, businesses win, stock investors win, FD holders lose. When repo rate goes up, FD holders win, borrowers lose, stock market slows. So this one RBI decision decides who benefits and who struggles. So next time you hear on the news, RBI changed repo rate. Remember, it is not a boring banking number. It decides how much EMI you pay, how much interest you earn, whether the economy grows fast or slow. If you understand repo rate, you can make smarter decisions about loans, FDs, and investments. If this helped you, subscribe to RBI for simple finance explained in everyday language.